As we plan for retirement, there is a whole lot to think about. So if you're retiring earlier, what are you going to do about health care? When are you going to take Social Security? What do you need monthly to live on? What does your debt picture look like? What does your investment portfolio or your portfolio allocation look like? And what's your withdrawal strategy going to be? There's just so many things. Hey guys, welcome back to Old Guy Talks Money. Like I said in the intro, there's a whole lot to think about when you start planning retirement or you enter retirement. And one of the things I thought that y'all might find useful was to share my portfolio allocation and kind of what my withdrawal strategy is going to be. Now, I want to give you a big caveat. I am not saying that this is the end-all be-all, the best strategy. But I think the power of YouTube is people sharing the information for other people to look at and maybe spark a thought for them to consider. Again, I'm not telling you this is what you need to do. I'm saying this is what I've done. This is why I'm doing it, and I'm going to walk you through it. And then maybe it'll give you something to consider as you plan for retirement or as you move through retirement. We'll just go from there. Before we do that, though, I want to share my coworker with you. So here's my coworker, Willie. She's a 5-year-old Australian Shepherd. If you saw some of my earlier videos and you wondered, why is this guy doing finance videos with AI dogs? Well, this is the inspiration. She's my constant companion during the day. You can see she has a really tough life laying on that pillow and with her baby, and she is just chilling. Matter of fact, she's outside now sunbathing on the deck. So just want to share that with you because she's an important part of my life. Matter of fact, sometimes you may actually hear her barking in the background. So as we talk about portfolio allocation, I think everybody would agree that one of the most important things to make sure that we consider is diversity. Okay, you don't want to be all in one stock. You don't want to be all in bonds. You know, it's a difficult conversation. You know, how do you make sure that your money's going to be protected and is going to last, 30, 40 years in retirement? You know, there's some rules of thumb. One rule of thumb from an allocation standpoint between equities and bonds is taking your age from 100, and that will tell you the percentage that you need to have in equity. So, for me, I'm 60. If I subtracted that from 100, that would say that the rule of thumb would be I needed 40% in equities. I will tell you, I am not that conservative of an investor. That would not work for me. I will also tell you that if you read the articles, that there are people out there that are saying that the 100 minus your age is too little. It needs to be 110 or 120. So just some things to think about, but you do want to have a good allocation between the two because you still want growth in your retirement, but you also want that stability provided by the bonds. Okay, so typically when the market's down, the bonds are up and they kind of play together. All right, so what have I done? Well, I'm going to tell you honestly, I don't know that I love where I am. I started planning to retire at 65 years ago. The challenge for me at the time was I was a relatively high earner. I was in a 32% tax bracket. And as much as I would have loved to have been growing tax-free money through a Roth, I was incomed out. And even though I could have done backdoor conversions, it just made more sense to defer that tax because it was so high. I know I'm going to pay tax on it in the future, but that's just how it was. So let's look at what my portfolio looks like. Now, the other thing I will tell you is I really believe in being transparent, and I had considered sharing the dollar values associated with my portfolio. I'm just not sure I'm ready to do that yet. There's so much criticism already on the interweb, and I didn't want to hear, I can't believe that's all you've got. I can't believe you've got that much. Times are hard. You're sitting out here making videos. I'm going to start here and just show you the percentages. As we move through time and the channel grows, maybe I'll get to the point where I just say, guys, let's shuck some corn and here it all is. But right now, this is what my portfolio looks like. So Domestic stock is going to be right at 64%. And I will show you what the positions are in a minute. I have about 6% in international. Now, how do I feel about this? I think my international may be a little low. I'm not telling you. I feel like it needs to be more like 10%. But y'all, I have a U.S. bias. I just do. I understand the theory is that you want the international market to help make up for when the U.S. market's down. I get all that. For me personally, right now, I'm comfortable with that small exposure. I may change it as we move through time, but that's where I am right now. All right, right at 13% in bonds. Now, that's going to smell low to y'all, because if you think about what I just said, I think a lot of people would say a good, just, back of the envelope allocation going into retirement, 60-40 split, 60% stocks, 40% bonds. And I'm sitting at 13%. I'm going to explain why I did this. It doesn't mean it's magic. It does not mean I'm right. This is just where I am. All right, so 13% bonds, and again, I'll show you the holdings. Right at 7% in cash. And again, y'all may say, well, that's a good bit of cash. Why are you holding so much cash? Well, the majority of this is going to be my emergency fund. Also, the uninvested cash in the various brokerage accounts that I have. So that's that. And then I have almost 12% in deferred comp. So what do I mean by deferred comp? Well, we had a non-qualified plan where I was that allowed us to defer income. Essentially what they said was, okay, we're not going to pay you now, we're going to pay you in the future. So they deferred the compensation. Why that was meaningful to me was when you're sitting there paying 32%, at that top end, I'm trying to save all the tax I can. So what I was trying to do was set money aside that I could then take after I retired and build a bridge to 65. Now, why 65? Well, my initial thought, and I don't know if it's changed yet or not, but my initial thought was if I can make it 65, I can turn on Social Security. It'll be more than what it is at 62. Yes, I'll leave money on the table, but it'll take a whole lot of pressure off the portfolio. And if I need it at that point in time, that's what I'll do. Because what I've essentially done is protected myself from sequence of return risks. So I built a bridge between the cash and the bonds. I essentially have 4 years. And when I say 4 years, I'm talking about after this year of living expenses paid for. That's in there. That's, it's basically risk free. When I retired at the beginning of this year, between savings and accumulated vacation, I paid for my entire this year. So I moved it into my account, set up sinking funds for everything I paid annually and quarterly. I tried to set as much aside as I could, and then I'm just letting everything else ride. When we get into next year, and the way this deferred comp plan was, when you put it in there, you had to tell them how you want it. And I said, I want it, over a 4-year period. So I'll start taking it, in 26, 27, 28, 29. And then between that and the bonds that I have set aside, that will pay for those years. And what that's going to allow me to do is let this equity position and the domestic and the international grow over the time. It protects me from sequence of return risk. And I can tell you that if you watch the market lately, although we've kind of bounced back a little bit today, at least when I recorded this, but we've been down pretty significantly this week. Trying to see if I can do this from memory. I think I have some positions that I went into early in January that are down $20 a share. Does it bother me? I don't love it, but I'm like, okay, unless it stays down like that or keeps going to zero as we move through time, surely by the time that I need to actually look at this, it will have come back. So my plan is, between this and what I've got in bonds, I will move through the next 4 years. I will have to reposition to kind of replenish this, allocation. I'll have to kind of do a rebalance, but it makes me sleep a whole lot better. So again, this is when I say I don't know that I love this. If I had a perfect world and I could go back in time and wave a wand, I'd have much more Roth money than I have. I would probably be a lot more comfortable being a little bit more aggressive with my equities, have a lot less cash. Again, this is what I'm doing. This is why I did it. Now let's look at the holdings. All right, so same thing that we're looking at percentage-wise, although I will tell you I'm an accountant nerd enough to tell you that if you add all these numbers up, it's actually 100.01%, but cause of rounding, and I just wasn't going to change it. But if y'all check this, because, again, from being an accountant, that I just do it. So one of the things you'll notice is I really have a very simple strategy. I'm not in a whole lot of positions. So let's walk through these. So on the domestic side, which is about 64% of the total, the vast majority, so right at 93, so let's call it almost 95%, is in SPY and VOO. SPY and VOO are both ETFs that are designed to mirror the performance of the S&P 500. And if you said, old guy, I don't get this, why do you have two? They're doing the same thing. Well, all right, so SPY is more liquid, okay? And it has a little bit different structure, but because it's more liquid, it's primarily used for trading, okay? Because you can trade options on SPY daily. And when I was trading options heavy last year, SPY was one of my go-tos, okay? Because you could set it, 7 days, 8 days, whatever you wanted. If you wanted to, conceivably, you could go in and trade one day. VOO, in my opinion, it's less liquid, and I would say the difference between the two, if I was going to be a trader, I'd trade SPY or hold SPY. If I'm going to be a long-term holder, I'd hold VOO. VOO has a 3 basis point expense ratio. SPY has a 9. SPY has a different structure, and the reinvestment in dividends is slower because they hold the cash and distribute it periodically, where VOO happens as soon as the dividends are distributed, they can be reinvested. So they're essentially doing the same thing. So why did I pick two? Well, one, I have a brokerage account that I am going to continue to trade options on. It's in an IRA, but that's what I'm using this for. VOO is my set it and forget it. Okay, so that's why I have that. I do have a small position in Truist. This is the only single stock that I own. It's one that I have owned since 2008, maybe. I don't know. This is one that I traded options on. I may eventually, now that I'm retired, get rid of it just so I don't have that one position. I will tell you, most people would say, owning single stocks is probably okay as long as it's not more than 5% of your portfolio. That's kind of what I've heard. But I do own that one single. Acorns, if you go back and look, I actually did a video of the Acorns app. This is an app where you link your bank account, your credit cards, it rounds up, transfers the money, and then invests it like you say. It may be a misnomer because this is probably in some blend, but rather than trying to break out the small percentages, I just said, okay, we're just going to consider it all stock. I like this app. I've been using it for years. This is not sponsored, please understand that, but I think it's a good way for young people to kind of get exposed, to kind of start saving. I've got at least one of my kids that are using it. And if they'll do it consistently, they're 23, and if they'll do it till they're my age, that number's going to get pretty big. All right, so that's the domestic. All right, on the international side, okay, both of these are Vanguard funds. They both have very low fees. If you said, oh, Guy, why do you have two? Well, I started several years ago trying to do the 3-fund strategy between bond, stocks, and international, and VOO is what I picked. What I will tell you is VXUS has broader exposure. It does include small cap, medium cap, large cap. It has more funds that it invests in. The dividend is lower than VEU because it does invest in those small caps, but they are essentially the same thing. Now, I decided to go with the broader exposure as I moved in retirement. This is one that I had, again, prior to retirement. I may consolidate these in the future because I understand why hold, because I'm sure there's crossover. But that's that. All right. On the bond side, and y'all bear with me on this because I don't have a really good explanation for this other than B&D is a Vanguard bond fund. It does invest in treasuries, mortgage backs, and corporates. It's just a safe bond fund. When I went into retirement, I wanted to experiment with holding individual bonds. So I did go out buy treasuries, individual treasuries. I set up a bond ladder. Is there any magic to it? Does that make me great and wonderful? No, it's just something I had never done. I wanted to see how it worked. And I knew that I wanted exposure to bonds. You can hold me to this if you want, but it's just my opinion. I feel like rates will eventually come down. And I was able to lock these in. These are all 4.6 or better. I don't think I had any 5s, but I'm willing to go 4.6 with this, as we move through time throughout that ladder. So probably could have done the same thing here and just put it all in this. Although I will tell you that when you look at the yield here, I'm actually getting better doing the treasuries. Now I understand I got a cliff coming up when these things mature, but that's why I did it. All right, over on the cash side, so I have my emergency. That's the bulk of what was in that cash. I told you that. This is the uninvested cash that I have in the in those brokerage accounts, and then I did put some in just a Vanguard U.S. money market fund. Okay, again, this was just one of those things where I wanted to do something a little bit better than just leaving it in cash. As we move through time, this may go down. This is in the account that I'm trading options, so I wanted to have it available because, as the price goes up and down, and if you're doing secured cash puts, you got to have the cash in your account to place the trade. So I just wanted to have it available. Again, I don't know that I love this. I may change this, but this is just where I started. And then lastly, this is the deferred comp. I explained to you how that was going to work. It's in a Fidelity government money market. At the end of last year, it was earning 4%. I know this is going to come down. I don't love this. One of the things that I've got to do is do some research because I know I've got to take this money over 4 years. Okay, so basically what they do is they get it in the year and they go, this is your balance. You get 25% of it. The next year, they'll get it into that year and they'll say, you got, this is your balance and divide it by 3. What I don't know is if I'm able to say, let's put 1 year or 2 years in the money market and the other 2 in, a large cap or small cap or something, so I can try to pick up a little bit more earnings. That's something I've got to explore. I set this up in this money market account this way because I did have it more aggressive as we, got close to retirement last year. I think it was probably 6 months out. I was like, okay, I'm going at the end of the year. I'm moving it all to cash. I want to remove the volatility. I realize I may be losing upside. I may be protecting downside, but that's what I'm going to do, and that's what I did. I don't know that I love it because it kills me to not be eking out as much as I can, but it may just be that I live with it because there is sleep comfort in knowing that I'm going to get, essentially 25% of that over the next 4 years. And with what I've got in bonds, as they mature, I will be able to fund that 4 year, and hopefully, this will grow and replenish what I've taken out, and then I can rebalance. That's kind of my strategy. Is it the right strategy? Yeah, it is for me. Is it the right strategy for you? Probably not. But I think there's power in people going out and talking about why they did something, what they're doing, how they did it, or whatever. So somebody else can look at it and go, well, that's the stupidest thing I've ever heard of. Or you know what? That's not a bad idea. That's something I can look into because there's just power there. So there you go, guys. What I did to prepare for retirement from an allocation standpoint, how I've kind of structured my disbursements over time. I will tell you, if you said, hey, you talked a little bit how you're going to take the money, but what percentage are you talking about? Yeah, I like the 4% rule as a base. I like the math behind it, but I don't know that it's the best strategy. Go on YouTube and look. There are people out there that will tell you that you're going to end up with way too much money if you follow the 4% rule. They're telling you, there's people out there telling you that's too high. It needs to be 3.5%. There's people out there that propose guardrails that when the market's good, you go up maybe to 5%. When the market's bad, you go down to 3%. It's all over the place. I decided I would use 4% as a guideline, as a rule. Personally, though, in this first years, until I start taking Social Security, it's probably going to be bumping 5% for me. And I don't love that. I don't like that being aggressive early on, especially with the sequence of return risk. But again, the strategy that I've come up with to kind of let this grow says, okay, I'm willing to be a little bit more aggressive, because obviously once you turn on Social Security at 65 or 67 or even 62, it takes a whole lot of pressure off the money you've got saved, because the average Social Security is about $1,900 and some change, and it changes all the time. But last I looked, so let's call it $2,000, $24,000 a year. That takes a whole lot of pressure off your portfolio. But big picture, I'm trying to stay around the 4%, knowing early on I'm probably taking closer to a little over 5, but I know once I turn on Social Security, it's probably going to bump it down to closer to 3, or maybe even in the high 2s. I haven't put pen to paper to see. So I've said a lot of words, and I shared a bunch of information. My goal today is not to tell you what to do, not to tell you you're wrong if you think different than I do, but just share what one guy did, why he did it, for y'all to say, you know what, there's something I can think about there. So if you've enjoyed the content, you're enjoying watching the videos, please hit that like and subscribe. I'll put the little thing up there, but it will help me grow the channel, and I will see you guys in the future.